Let's discuss term riders as they relate to whole life insurance policies and implementing infinite banking. Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today's installation in our EncycloMedia series, we're going to consider the term rider. Now, the longevity, let's start with that, the time. The longevity of a term rider could be something like 10 years, 20 years, 15 years, 30 years. So a rider is something that you attach to and in this case, it would be a whole life policy, a properly structured whole life policy with a mutual company that pays dividends. And in certain cases, not all cases, but in certain cases for a custom built policy, to implement the infinite banking concept, a term rider would be attached to the whole life insurance policy. So it's something that is attached to it, and the typical duration could be 10, 20, 15, 30 years. Now remember that the term rider will accumulate no cash value. It in and of itself will only be producing more death benefit. So no cash value will be generated by the term rider itself. So all those premiums are just buying the death benefit amount that it produces, that particular term rider, for that particular term, for that particular amount of time. Now, this term rider may or may not be convertible. That's going to depend on the company and this being built in this particular way. That's why it matters so very much who you work with. But if it is not convertible, then it will be on the 10 years, the 20 years, the 30 years, and then it will simply fall off. You would see that reflect in the death benefit of the policy. It would be reduced. The death benefit would be reduced by whatever amount that term was providing. If it is convertible, and we'll talk more about that soon, it's possible for that term policy to, in part or in full, be converted to a whole life policy. Now, if it is a convertible term rider, then that would lock in a certain amount of death benefit, and that policy can be structured for having high cash value like you would want in a banking style policy. When that term is converted to whole life insurance, but it would lock in that amount of death benefit for you to be able to convert into whole life insurance within that allotted time frame based on how that contract is with that particular company, but without having to subject yourself to medical underwriting at the time of conversion. So when you buy the convertible term rider, it's something that you have locked in death benefit. You wouldn't have to subject yourself to medical underwriting at the time of conversion. So it is very beneficial for those reasons. And again, you would have the option to convert it. It's not something that you would have to do, but you would have that contractual opportunity to be able to do that contractual right to be able to convert part or all of that policy. Now, it does add a layer of complexity in having a term rider added to a whole life policy, whether it is a convertible term rider or not. It does add another layer of complexity, but there are some good reasons why some would benefit from having a term rider. For one reason, you're able to add a significant amount of death benefit more to what you would have just with the properly structured whole life policy and at a fraction of the cost, which is great. Being able to have a larger amount of death benefit for those 10, 20, 30 years, even though it doesn't create any cash value in and of itself, those premiums, but to be able to have the additional protection that you would want to meet your needs, whatever they may be. And that's, again, why it's so important to have a custom-built policy. Now, by buying additional death benefit via the term, that is going to allow you to protect yourself from the MEC, the Modified Endowment Contract, in different ways, meaning that by having a larger death benefit, you will be allowed to pay more premiums than you otherwise would have on this policy. Because of the term rider and the death benefit that it is buying, you will be able to have perhaps a greater portion of your premium go towards the paid up additions rider without meching your policy, without turning the policy itself, the whole life policy, into a modified endowment contract. So it would allow you to be able to allocate more of a greater percentage of your total premiums towards the PUA, the paid up additions rider, without meching the whole life policy. Something else that adding a term rider to a whole life policy might do is allow you to facilitate a greater dump into the policy in its first year. Meaning that if you have the properly structured whole life policy, and that policy is going to receive a dump in, whatever the number is, 10,000, 10 million, whatever the dump in is. Having a term rider would allow you to facilitate a greater dump in the first year of the policy. So again, I'm just speaking to the generalities of what a term rider is, what types of term riders there are, why you would consider perhaps, depending on your case, why you would consider perhaps having a term rider to be able to facilitate a large dump in, or to be able to facilitate a particular structure that you're looking for. Again, I'm suggesting that everybody consider Nash's 5 principles when implementing the infinite banking concept. Think long range. Don't be afraid to capitalize. Be an honest banker. Don't do business with banks. Rethink your thinking. I did kind of emphasize don't be afraid to capitalize, because in this space, there are those who will build a fragile policy, putting too much of the premium towards the PUA and not a significant enough portion towards the base policy itself. And that does create fragility into the future. And the more parts that you continue to add to that policy, a dump in here, a term rider there, it just creates a complexity that is not necessary for everyone. Likewise, there are cases to be able to facilitate a custom-built policy for someone who's genuinely implementing the infinite banking concept, to be able to facilitate a dump in, to be able to facilitate the particular split, which is another IBC term that we cover here on the channel, to be able to facilitate the split that you're looking to have built into your policy, and other factors. A term rider can be a great addition, helpful addition to covering lots of boxes that you want, like the additional protection at a lower cost, helping with the structure of the policy that's been custom built for you. I don't have a cookie cutter approach when it comes to policy construction. So again, as always, don't hesitate to jump in my calendar so we could talk about what implementing infinite banking could look like for you. But this has been a great pleasure for me. I look forward to our next conversation. You can reach me at durhamtalents.com. Have a great day. Take care.